Hi guys, welcome back to Marantz. Marantz, plenty of good information, a little bit of motivation, a whole lot of truth, no financial advice. First off, meet Kevin. Hi, meet Marantz. I study GameStop for a living. That's what I do. Do they pay me for it? No. But I know who you are. A lot of people know who you are. You have a huge platform, and I think it's pretty irresponsible for you to do this video. But hey, I watched it one time. I went back. I had to go see some stuff, read my stuff, and then be like, okay, Kevin absolutely has no idea what he's talking about, but it's fine. He's going to go ahead and try to break down brick and mortar. He's going to try to break down retail. He's going to try to break down GameStop. Well, there's people like me who actually study GameStop every day, so it's going to be really difficult for you to get this one through. I will tell you this. You had a 14-hour turnaround time on this video, as from right now when I'm recording, to be out 2 hours after the earnings report with this detailed report. And you obviously have an agenda. That's my opinion. But let's go ahead and break down the FUD, the nonsense, and we'll watch it together, guys. So excuse this video. It's going to be a little bit longer because he made it long, and it didn't have to be. All he had to do was cheer, be happy, and know that he's not involved, right? So, hey, meet Kevin. Hi. I've never met a felon, allegedly, but I have met a failed politician once or twice, and then a guy who's actually here pushing out FTX on the people, and you're worried about GameStop? Come on down, baby. I'm here.
GameStop, what the hell just happened? That looked like an amazing report. We gotta go through it because, wait a minute, is it actually that amazing? Is Kevin here to ruin the day again? Nah, I don't want to ruin the day. I want to tell you the truth. In fact, I want to play the Buy the Dip song again because after all, the last time GameStop went to the moon on my birthday, January 2021, we had a good party. The problem is, then GameStop was no longer available for buying on Robinhood and the party was over. But now, we have the fourth quarter earnings report for GameStop, and it's worth diving into the actual report to see what's going on, because there are some interesting things going on that you should be aware of if you're a GameStop shareholder.
So you should be aware that GameStop announced that they actually made a profit this quarter, and they had planned to make a profit every quarter moving forward. So this is going to rub a lot of people wrong, certainly people that are on the opposite side of the table, whether you're long versus the short. So Kevin's kind of painting himself in a corner here, and I wish him the best of luck. But after this video, everything he says is pretty much explainable. So we'll do our best. How about that?
Now, I wasn't expecting to make this video until tomorrow morning, but because this is breaking news, I figure, hey, let's bring it to you as soon as possible. So there are a few things that I think are quite interesting in this earnings report beyond just the headlines, which are, okay, hey, we beat on revenues, we beat on adjusted EPS. That's fantastic. That's wonderful. Let's actually go nitty gritty though, and maybe try to understand, is there something more to this? And I think the answer to that, unfortunately, is yes. So what do we got? Okay, well, the first thing that we need to know is that all of a sudden we saw the cost of sales section jump almost 600 basis points, actually more like 650 basis points. Basically, all of a sudden, their margin was greater by about 6.5%.
5.5. I'm not good at math, but 77.5. Is that what you put there? I would assume. Add 6.5 to that, and that's going to be 84. But hey, your math is close, kind of like everything else. A little off, but go ahead.
Now that seems phenomenal, right? When I first initially wrote this down, I'm like, wow, GameStop is really cutting their costs on their costs of sales. Now that's fantastic. One way you could do that is potentially having fewer employees selling a similar amount of goods. Technically, sales at the company, both year over year and quarter over quarter compared, were negative, right? So net sales are actually shrinking. All
right, we'll stop there. As many of you know, GameStop has shortened their footprint from year over year. So, of course, top-line revenue would be down, but you have to look at it, all things into one. So the cost of good, well, I'm going to get to the cost of sales part, but as far as top-line revenue goes, don't tell me that GameStop used to make $9 billion, 5 years ago, because they had 7,500 stores then. They've cut it down all the way to 4,200. But I'm going to let him keep talking, and we'll keep going from there. But yeah, the net sales, top line, it's supposed to be down. We've shortened our footprint. We don't have as many stores as before.
certainly not a growth company in terms of revenue, but all of a sudden their cost of sales decline. And that made me think, well, fantastic. Maybe they're becoming more efficient. But unfortunately, that's not exactly the only reason this margin looks so positive. And I'll talk about that in a moment. Now, SG&A did fall substantially. I mean, we have almost an $80 million drop in sales and general administrative expenses here. So a lot of that white-collar office work cutting to try to run the business with fewer people. Okay, that makes sense.
Let's not just walk over that number. That's $80 million. You mean to tell me, just so that we're clear, Kevin, that last year we paid $540 million to do business, okay? And I'm not talking about the cost of goods, the cost of sales. I'm talking about actually doing business. It cost us $540 million to get 2.2. We still got 2.2, but we did it for $80 million less. Do you understand the ratio? Do you understand the delta of what that is? How great that is? No? Okay.
That's how they ended up getting a positive EPS when the expectation on Wall Street was that they were going to lose more money. So the fact that we had a positive earnings per share set here of 16 cents, absolutely phenomenal. So what's the problem then, Kevin? After all, the CEO brags about how much cash they have. Look at this. Cash.
We got to stop there. First, the negative condensation you come off with. Kevin, if you're going to give out this report and you want it to be taken serious, you can't say that they're bragging about things. No one's bragging about anything. This is math. They put up what the balance is. They put up the chart. They put up the sheet. That's it. There's the word brag and then announcing what the announcement is. Bragging, what did he go? Hey, is he Adam Aaron all of a sudden? It's okay. We'll use your terms here. He's bragging, or maybe he's just pointing out the facts.
Cash equivalents, and marketable securities, $1.39 billion at the close of the quarter. In addition to that, they basically only have a $40 million loan. And in their earnings call, what did they say? Well, in their earnings call, they bragged about how they pretty much have no debt. So they're kind of dangling this carrot of, hey, we basically got about 1. All
right, we got it, right? We got it. They didn't brag. They just told you the number. Said, this is what we have. This is what we do. Not bragging.
$4 billion in cash and pretty much no debt. That sounds fantastic, right? Yes, but it's not exactly what the statements actually show. Now, I'm not trying to do this to be the bearer of bad news. I don't have a horse in this race. I'm like, I want to be part of the crowd. I want to buy some calls tomorrow. I want to buy some of the...
You couldn't be part of this crowd if you wanted to, because we didn't just buy it yesterday. We've been buying this stock for over 2 years, Kevin, while you've been pushing out every hot stock you can. This is why you're in trouble. This is why you're getting sued. Don't ever try to associate yourself with this is a movement, this is a crowd, this is a rush. Oh, I want to go buy some calls. That's not us. That's not me.
Stock, but after looking at the statement, some of my enthusiasm is going away, and I'm not shorting the stock. I got no horse in this race again. But let's look at this. Let's look at this. So if we jump up,
hey, this guy's got no horse in the race, right? But yeah, he's got a balance sheet with highlights and notes. He's ready to go. This guy. Let's do it, Kevin. I don't need any of this, by the way, Kevin. I'm sitting right here in front of you. I don't need any of this because I study the stock. But we'll go for it.
On over here to the cash that they have. The first thing we could do is it's split up a little. At the bottom of this PDF, you can see cash right now is 1139 million, right? Cash and cash equiv, 1139 mil. Okay, perfect. Let's add that together with marketable securities. And what do we get? We'll hold on with the receivables. We'll come back to receivables in just a moment, which is right here. Add in the 251 and you get that about $1.391 billion the CEO is talking about. That's fantastic. I want to have $1.3 billion sitting around. Oh, but wait a minute. They have bills to pay. They have a lot of bills to pay. But because they're just bills and technically not debt, the CEO is bragging about having low debt while having bills sitting on his desk of $531 million and other accrued and current liabilities of $602 million. So all of a sudden, no debt turned into $1.133 billion of debt.
Okay. So this is the easiest part of this whole thing. I hope people don't get caught up on this. The previous quarter, GameStop had, I believe it was like 1.1 billion as well, 800 something million on accounts payable. And everybody was quoting out loud. Everybody's like, oh, they have debt. They just didn't pay their bills. They're carrying it over to quarter four. And as you show up to quarter four, as you can see, this line here, these current liabilities, and they call them current for a reason, and that's because it's the cost of doing business. It's like the cost of to keep the lights on. It's your utilities, basically. And as you go through and you say, you know what, this is what I have to pay to do business each month. Now I have money coming in and I have money leaving each month, okay? And it's cyclical because we know that 40% of the business we do at GameStop is in quarter four. So that means that the bills from quarter three came over, and this is what's left. Now, what did we pay? We carried over what we have to. Every quarter, it's been this way since the beginning of time. This is all business, by the way, Kevin, not just GameStop, right? So I would give it to you like this. GameStop increased cash on hand $300 million, almost $400 million. You're going to admit that in a minute. So $400 million cash on hand increased, but yet liabilities stayed flat from quarter to quarter. So how is it that we have an increase? Well, I mean, where are the liabilities from the previous quarter? Why is the 800 not put on top of the 500? Why is there not 1.3 billion here? And because if you paid the 1.3, right, then it would come out of the cash? No. We're pocketing cash. That's what free cash flow is after it all. So you can sit here and tell me what the bills are per month, and I'll show you every month for the last, 20 years GameStop's been in business. You don't carry over those liabilities. They're called current liabilities. The long-term debt is the issue that most companies can't get out of. Long-term debt would be debt, right? Interest rates on top of that you pay per month would be the debt that's incurred. This right here is just the cost of doing business. You're absolutely embarrassing yourself. If you don't know what cash on hand means, that means that GameStop literally could write a check right now for $1.1 billion. $1.1 billion, marketable security. Treat it like a person. Treat it like yourself, right? So I have a brokerage account. It has an amount on there. Let's just say it had $251 million like GameStop's does. I don't have that money here, personally, cash, but I could sell my stock and then I could go get my cash. That's what GameStop has. Additionally, they have money in the bank, their savings. And if I needed that money, I could go grab it. But yes, I have bills per month. And yes, it churns and I pay those bills. Because if I didn't, then I would default. And then it would be a bigger mountain. It would be deferred rent and it would be deferred liabilities. GameStop doesn't have any deferred liabilities because they're going net cash, dollar for dollar. If you don't understand that easy part, then you saying that this is an expense or this is a debt, that's not true. The terminology you're using is incorrect, but it's okay, Kevin. You can be the bearer of bad news. Bear. It's absolutely embarrassing, by the way, what you're doing, because if that were the case, I'm just going to explain something to you, Kevin. I want to know where you're going to make this video about AMC or any other company that current liabilities per month trump the cash on hand, yet they also have corporate debt of over $5 billion. So nobody has cash in hand, apparently. No, they don't have cash on hand because their liabilities are $5 billion. No, they still have cash, man. They still have cash. They can go grab it and go put it somewhere and go buy something. Right? I don't know. Maybe you really don't understand how to read a balance sheet, but this is laughable. No, it's not debt right there. Current liabilities are not debt. Not per se. Not like the way you're trying to characterize them.
Now I'm going to assume all of their receivables get paid. Okay, so we're going to add in the 153 mil in receivables. So we'll take all their cash, that 1391, minus their payables, 531,602. Add the receivables in, and this is how much cash they really actually have. $410 million. Okay, well that's actually pretty decent. It's not $1.4 billion, and it doesn't consider that they owe about $40 billion on their COVID loan. They paid that down from about...
He said 40 billion, it's 40 million, right? And it's not due until 2026, and the interest rate is less than 1%. 1% on $40 million. I think it's like $39 million, whatever, it doesn't matter. They could sneeze and pay that. They're going to be like, oh, my bad. They just don't have to. 2026, man. Let your money work for you. Certainly not during this inflationary period. But hey, I'll let you sit here.
46.2. That's okay. So we've got about 410 in free cash, pay off the COVID loan at the French government, which you don't have to. That's about 370 mil in free cash. Okay, that's actually good. I will give them that. That is good. It's clickbait to say it's $1.4 billion, but it's still good that they actually have somewhere around $400 million in cash around. That is good, especially since they're not burning cash right now, but they are burning something else. And I want to show you what they're burning because
I just want to put that out there. They're not burning cash because the current liabilities don't affect the cash line. That's the issue. GameStop makes more than the liabilities. Okay? Are we clear on that? They make so much more money than their liabilities that they're able to park $250 million into marketable securities, i.e. make interest off the money that's on the books because cash doesn't make you money. This is tough for this guy.
It's actually really important for the future of the business to understand what this next thing is that they're burning. But I do, as usual, because this is what I do, this is how I make a living, I have to pitch the programs on Building Your Wealth, link down below.
Holy shit. In the middle of your video, you're doing a pitch? Because this is how you make your living? As if having almost 2 million subscribers on YouTube wasn't enough. You already on this video yourself have 42,000 views in 13 hours. And I know how much money that pays you. And you're telling me that's not enough? You got to go pitch some bullshit ass program? Hey, Kevin, not only are you an alleged criminal, okay? If you're about the people and education, why not give it for free? I'm asking you. I've always asked this to everybody. If everyone's so successful at trading and they know so much about the stock market and they've made millions of dollars, real estate and stock, why would you charge people for the information you're going to give them? Why can't you just give them the information? Why can't we all be winners? I put more time in on YouTube than you do, Kevin. Every day. With probably better content, by the way.
With an expiring coupon code tomorrow. That's because I go through deep dive fundamentals like this almost every single day in our course member live streams, and we've got some amazing special live streams for people looking to increase their income, protect themselves liability wise, insurance wise. If people have got tax questions, any kind of questions.
I got a question. Are you gonna give me any advice on how I should invest into a crypto platform by the name of FTX? I'm just asking.
You have. I do my best to give you perspective. Obviously not from the point of view of personalized advice, but to get you started in the right direction of where to get the best answers and the best questions to ask your own CPAs and lawyers and get started the right way. So check out those programs on Building Your Wealth, link down below, whether it's Stocks and Psychology of Money, the most popular, or the most popular bundle, the Zero to Millionaire Real Estate course, which often gets bundled with this, or the next one, which is the Elite Hustlers University. All right, so what's the next thing that they're burning? Well, that's actually right here. So what do we got here? See this section right here? This is the cash flow statement, okay? Now this is very complicated, so I'm just gonna keep it as simple as possible. See this section right here? Merchandise inventories. Okay, usually when a company is spending money to build up inventories, they have a negative merchandise inventory sector or line item. Anytime you hear cash flow, you want to think about what did you do with cash? If you spent money, the number is negative. If you received money, the number is positive. So let's compare for a moment. Go to Enphase, a growing company. What do we have over here? For inventory, well, inventory is very clear in this green section right here. For the 3 months ended in these 3 different quarters and the 2 years ended, all of the numbers right here, all of them are negative under the inventory line, right? That's normal because they're growing their inventory. Go to Walmart. What do you see under inventory? Negative inventory on the cash flow statement. Negative inventory means you are bringing in more inventory than you sold. When inventory on the cash flow statement is positive, like it is here and like it was last year, it makes you have to ask yourself, did they either prop up their inventories too much during COVID, which they say they did. In fairness, they say they did, and they're going through that inventory. Or are they liquidating because they realize certain segments of their inventory won't be profitable much longer, and so while they're selling that inventory, potentially liquidating it, reducing the prices, getting it sold, basically get it sold, get it sold, get it sold, and then not rebuying it would be another explanation for having a positive merchandise inventory. You have positive merchandise inventory when you sell more goods than you receive. Now let me...
Okay. So that means that what he's trying to say, essentially, is if they're not in the negative, that means that they're not bringing in enough inventory. It's not actually churning the inventory. The unfortunate part is they have to understand the business model. You cannot just cherry pick your information. I don't know what company he showed you. The first one, all negative inventories. We don't know if they're a delivery only company. However it may be. A couple of things come into play whenever you're thinking about inventory levels. The first thing is, where do you store the freight? That's the first thing you always got to think about. Like whenever I go into a store, I think about, well, how much space do they have in the back to hold inventories, or is this all the sales product? Like if you go into like a clothing store, most of all the product is hanging, right? That's just what it is. But they're not going to have boxes and boxes in the back because what's not being seen can't be sold. When you think about GameStop, just give you guys an example, very small stores, they don't have the holding capacity on hand. Therefore, if you were to increase inventory levels and then decide to sell through it, you're going to be sitting on a lot. So that means you're going to have a lot of what they call clearance, right? I mean, just for lame way of thinking. You can't compare Walmart to GameStop. If you're going to compare anything, you'll go to like Best Buy and you'll want to do, I think you could, I won't even do Costco because it's not even fair to you guys. But if you do Best Buy, there's nothing really in the segment that compares to what GameStop is. And here's why. Because the inventory levels for GameStop are reflective of the fact that they have 2 fulfillment centers and that they actually closed one down. They had a third one. And that they actually closed down numerous stores. So when you see an increase, it's like, hey, well, let's filter this out. I told you guys this. They did have the $1.1 billion worth of inventory. And the reason why they had it on there was because they were carrying over so that they didn't have supply chain issues. So they did have the product on hand. In our case, because gaming is so, how can I put this? The competition is fierce, right? So the margins are small. They're smaller than what the previous products were, like pet food that we used to sell if you were Chewy. But when you're looking at GameStop, I'll give you an example. The newest game comes out, Hogwarts, right? So why wouldn't our inventory be up like crazy? Money-wise, it has to be up because we got to go out there and get this inventory. And no, we're not going to churn it. We're going to sit on it first because we have to make sure we have all the copies. We need all the different types of Hogwarts coming out. It's the number 1 game in the world just in February. So yeah, so we got it a period before. If you saw what we did in Q3, we had it wasn't even 1.1. It was just $1 billion worth of inventory that we're sitting on. Now we sell through it and we're coming out the gate at 400 million. And people are going to be like, oh, well, they're sitting on inventory. Guys, it's not perfected yet. We haven't got there yet, but we're going to get there. You're going to get to that zero, to that negative number. But even the best companies have positive inventories for this period. And I'm talking about the Q4, the Christmas period. As you come out of it, as you sell, I'm going to tell you why it's a good thing to have a positive number and not a negative. And I always use this equation to you guys. It's the bakery theory. You'll never know how much you sell until you have enough to sell. Guys, if I made cheesecakes and I'm going to make them for the whole day and I sold out at 4 p.m., that means I lost sales for the next 5 hours up until 9 because I didn't have enough to provide to everyone. You'll never know how much you can sell until you stack it high and watch it fly. It works out that way in retail. Hi, Meet Kevin. I know you don't understand retail, but I do. Brick and mortar is different. Not only that, you have to pick and choose which companies you want to compare to. Show me the gaming company, the company that sells games, and I'll show you the company that's sitting on inventory because it's rotating through. These are titles that come out that sell in periods of time. I'll give you a PS4. PlayStation announced superior sales numbers for the holidays. That's how I knew GameStop was going to be great because GameStop loaded up in Q3 on PlayStations, and the orders of them all. So if you know what it is, there you go. Guess who got PS5s out of nowhere after Christmas? Costco. They didn't get them during Christmas because they're not going to pay the premium to get them there. GameStop did. That's why GameStop made the number. But as far as the inventories go, guys, to go from 915 million, Kevin, all the way down to 600 million, that's a $300 million drop off. Like, it's going in the direction as in the negative number. Did you know what GameStop used to do? They used to be in the negatives, 14, 15, 16. No, you didn't know that part? Here, I'll show it to you. Maybe I'm crazy. Maybe I've been studying inventories for too long. By the way, this is, I believe this is Costco, right? I want to make sure. Yeah, this is Costco. This is Costco. They had a negative inventory in 2022, right? They were doing the right thing. And now why are they positive the other way swing? Because they're stacking inventory so that the supply chain issues that happen back on these days won't happen again. They actually hold their freight on top of their store. Maybe you've seen it. We'll go over here. This is going to be Best Buy. Best Buy had negative, and now a positive 809. Is that a problem for them? Probably for them, because they're not selling video games, they're selling TVs, and TVs get outdated and outmodeled. But they're already doing bad business, and that's because I think they're infiltrated, but that's another issue. You probably don't know that part. You don't know what's going on. Let's look at GameStop. This is GameStop, and I want to get through it up here. I want to make sure everybody knows this is GameStop. Yep. And GameStop on inventories, just so we're clear. Come on, right here. So merchandise inventories were in the negative in 13, 14, and 15. Okay, so they had it going perfect the way you want them to, and they're going to get to that net zero number eventually. But what wasn't happening then and what's happening now is the competition is fierce for those consoles. So remember the consoles. You have to come to GameStop to buy the consoles, Kevin. I know nobody told you that part. I know you're going to say digital, but I'm going to say console. And here's why. Because as you look at the inventory levels, to go from 915, and we know it was at 1.1 just the previous year before that in 2021, now we're at 682. So 2018, 2019, 27, all these 2020s, they were built to be broken up. But inventory levels come down because they actually have less stores as well, Kevin. Factor that in, please, because it's going to happen. They're going to get better at what they do. Just watch. Watch your own numbers, and they'll explain it to you.
Let me ask you this. If you were a business that was selling Pokemon Cup collectibles, and you spent $100 on Pokemon Cup collectibles, and you made $200, well, you want to keep doing that because you're probably a profitable business, right? After your costs, you probably have some money left over. But if it's not profitable to buy these, what do you stop doing? Well, you sell what you have and you buy less. That appears to be what's happening here. Now, that makes me a little bit nervous because at some point in the future, if they want to continue up.
How does COGS make you nervous? Like the cost of goods, right? And sales. How does that make you nervous? I don't understand what you're nervous about. Like, these guys are the best at what they do. The best in the world. GameStop's whole board, their CEO, CFO, everybody is the best at what they do in the whole world. And you're going to tell me that you're nervous about inventory levels that have been going in one direction the whole time? You're just cherry picking your data. This is awesome.
Operating their business, they're going to have to go back to having a negative cash flow segment in inventory. Now, remember when I told you it was interesting how they managed to get earnings per share up so high?
Yes.
Partly because their costs of sales plummeted. In other words, they had this greater margin. Well, think about it, folks. Why would your cost of sales decline? Well, what if you didn't buy any more stuff? Just
that can't be the case. Because we're selling video games, right, that have releases, we have to buy stuff. That's the first thing. Second thing, what if we annualized on an inflationary number? What if last year they didn't understand how expensive it was going to be to sell said products because inflation was increasing at a rapid rate. What if inflation has fallen back and the cost of doing business is flush, is net zero, is flat? You haven't built in inflation into any of these numbers that you're thinking about. So not only have you not built in the footprint of what GameStop is, you haven't built in inflation either. The cost of doing business keeps coming down, right? SG&A, it keeps coming all the way down. How are we becoming better operators, selling the same amount of top line revenue, yet the cost is coming down? Maybe these guys are buying better. Maybe there's better buyers in that office. Like, have you even factored in that portion of it? You know, to mandate or to, I don't want to even say like force, that's the wrong word, but the buying pressure coming from GameStop has to be tenfold of what Best Buy is. Has to be. We have more inventory. We have more games on hand. Did you get that part out already? Did you figure that out? That we are doing more with less, and you're giving them zero credit for doing it. Instead of looking at the number and being like, I get it, because I get the time frame, I get the year we're in, I get the month we're in, I get the cycle we're in. You don't do any of that. You're just going raw number versus raw number, and that's ignorance.
To be extreme, if you just stop buying stuff, all of a sudden it looks like your margin is really, really good compared to a prior period. But at some point, you're going to have to keep buying stuff to stay in business, right? Yeah. And look, let's be fair. They have a bunch of assets still in inventory. So in fairness, they've got $682 million worth of junk that they could still sell people right here. So
worth of junk. I love this guy. There's never a one term that's endearing of GameStop. Oh, but I love it. I still have junk. Oh, man.
it seems like they got plenty of stuff. That's down from $915 million. So that's fantastic.
Oh, thank you.
But it's important to know that at some point, if the company goes back to actually expanding the assets that they want to hold, then what's going to end up happening? Well, they're going to have to take a charge for against cost of goods sold for actually buying the goods they want to sell. That's the nature of COGS, after all. Costs of goods sold, right?
Oh my God, that's the nature of it. Listen up, me, Kevin. They buy stuff every day, every quarter. What do you think is happening? Do you think that, like, when you say brick and mortar, do you think they sell paint? Like, there's only X amount of colors and they have X amount of inventory and they got to sell through all that junk before. This is a churn business. That means it's revolving. It's a new product after new product after new product. This is why it's so competitive, and this is why it's a little different than normal brick and mortar. No, they're not selling a brand and a product, and that's the type. I.e., if I sold Coke, that's it. I sell Coke. I sell bread. I sell milk. I sell eggs. I could go that route, right? Or I could be improving title after title after title after title for said console. That's the difference here. The collectibles are no different. They're constantly changing. The only mainstay is the hardware sales, and guess what they're up in? Hardware sales. I know.
So, to me, it seems like there's some liquidating going on. And that makes sense because A, maybe they overstocked in the pandemic, but it's also potentially a red flag that maybe they're starting to realize we need to get rid of the unprofitable stuff. Because in COVID, in 2020, their inventory levels were actually sitting right here at 859 million. Oops, there we go. 859 mil. In 2021, they were sitting at 602 mil. Now, this could be explained by the shortages, but they're suggesting they built up inventory so high they don't need to keep building up inventory. But wait a minute. Before COVID supply chain issues really hit, their inventory was around that 8,900 level, which
8,900 level with 7,500 stores, right, in 2018. And that's when they were running the wrong business. That's when they had the Boston Consulting Group within their company. They had KKR within their company doing all the wrong things. Okay. So once again, not apples to apples. You don't know the business. You don't understand it. All you're looking at is a balance sheet. Now look at the nature of how it got there. Because I just showed you 3 years prior to that where they had negative inventory levels. So you don't understand. I'll even go further than that. The reason why they stacked in $1.1 billion worth of inventory and what they are selling is because you got those prices at 0%, basically. And I'm talking about inflation wasn't a number, wasn't an issue at the beginning of 2021 when they were stacking inventory. Inflation became an issue once the Fed came out and said it's transitory. But tell me, Kevin, as I want to meet you, you got a little body, big head, bro. It's gross. Malnourished. I don't know. Are you married? I don't see a ring on there. Anyway, back. You gotta eat some food, bro. But back to the numbers. Apologize. You're cherry picking your data, but not actually putting into full context what actually happened to macroeconomics, like for the last 5 years. So we can do this. We can do the whole Fortnite effect. We can do the PlayStation cycle. We can do all of that. You have not taken anything into consideration other than raw data. That's it.
Actually kind of implies that they don't have a lot more bloated inventory that they have to sell through, because if things were like they used to be, you wouldn't be saying that. You would be trying to keep inventory levels propped up. So in my opinion, this is a little bit of a red flag that they're liquidating the stuff they don't want, which in my opinion is probably where they're actually starting to lose sales, and that is in software. Which makes sense. People can now digitally download products. They're still growing in hardware and collectibles, and they do keep bragging about collectibles, in fairness.
Once again, stating a number is not bragging, okay? It would be like me, I'm sorry, I don't want to do this. We're keeping it real. I'm so sorry. I'll do that for the live stream. Here we go.
Now, before we talk about that, I will jump over to 2019, okay? Because remember, they're bragging about inventories still being high right now because of COVID.
He said bragging again. I'm mad about it now. Hey, bro, that's like you bragging about the fact that you're 4 inches, okay? It's not a brag. It's just a statement of fact. That's all it is. They're not bragging. They're telling you. They stacked up, yes, COVID. And why? Because all their inventory was e-commerce. The only issue is they didn't have the platform to push it out. And now they do. Now they have 2 new fulfillment centers to cover the United States, and they have a better platform. Or maybe you didn't know where they put all their money. Well, not all their money.
Their inventories right now are like $692 million. You want to know what they were in 2019?
Oh, tell me.
Twice that.
Twice
Merchandise
that.
inventories, 1,200.
You want to know what GameStop's footprint was in 2019? Twice that. It was 7,200 stores, man. Like, you're embarrassing yourself. You're absolutely embarrassing yourself. The merchandise inventory levels should be sky high compared to the amount of stores that they had back then versus now. This is why our inventory levels are half of that number, because our stores are half of that number, right?
50. So in other words, $1.25 billion of merchandise inventories. Look at this page here. This is the front page. They talk about initiating cost cuts and then completing the majority of their implementations and upgrades related to the company's infrastructure, systems, shipping capabilities, and online and mobile platforms. Okay, hold that thought. So they're telling you they completed the implementation of all of these upgrades, right? Hold that thought. And then they talk about increasing their collectibles category, which is where the company continues to prioritize long-term growth. Well, they took collectibles from 13.7% last year to 16.3% of their total revenues. So they're prioritizing growing one of the smallest segments of the business. You can see that right over here.
Let's pause it. Let's pause it. Because he wants to show you how collectibles are only up 2 to 3%. And at the same token, you're going to find out that hardware went up 3%, and the lost number in software filtered through down to collectibles, right? So hardware or software was down 3.8%. So the additional fell off to collectibles, which we know. We know what that is. That's what they're pushing. I told you this. I said I wanted to see $1 billion this year. They came in a little under 950 something or 960 something $1 million. That's okay. It's not a bad thing. Can you imagine 4 years ago when they were like at $200 million, $300 million? Yeah, they've tripled this category over the last 5 years. But believe what you want. Do you think they're losing something? They're not losing anything. The money's still there. It's still going into the right sectors, but the top line sector would then be I'll give you an example. Hardware and accessories, and you can look at it right there. It's up about $60 million, right? I want to make sure I have this right. 60 million. Collectibles up another 40. That's $100 million. When you look at software, it's a $90 million swing. So plus 10. It's not a big deal for these three categories, but anything that you're losing is, I'm sorry, the other way around. Anything that you're losing, and I'm reading it right now, anything you're losing is actually going right back into the two categories that you're substituted for. It's not really a drop-off, guys. The percentage that you're down, you've actually increased. And it's always going to be that way because they're putting their focus into collectibles. Right there, $964 million what they had. They actually increased it $140 million. There's a huge growth area, and why not? There's potential there. The top has not evened out yet.
This is where 55% of their sales come from hardware, like pre-owned stuff. Software, 30%. They're trying to pump up collectibles. This is for the 13 weeks ended, and the numbers that I was showing you were actually for the year ended. So in other words, even though they're out, that's even worse. They're trying to prioritize collectibles, which they had 16.3% of revenues coming from collectibles for the year, but that actually decelerated to only 14.1% for the quarter. But that
for the quarter, how is that bad? Hold on, smart guy. You're mad about the quarter collectible coming down? Hey guys, it was Christmas. That means people are buying consoles. Go look at the top line where it's 55% because it's an increase of 2%, almost 3% over the yearly number. Stop this bullshit. Stop cherry picking data.
That's where they're trying to prioritize. But wait a minute. What about all of this capital improvement that they just talked about? They talked about like new apps and system improvements and other improvements for who knows what, right? Capital improvements. Okay.
Called Capex expenses, guys, the expenditures. Let me tell you something about Capex, okay? Before he even talks, or maybe I'll do it after he talks. Let him say his part and then I'll explain.
Okay, well, their cash flow statement tells you they spent $11.6 million in the quarter on capital expenditures. Well, the company has 2,954 stores. So if you divide $11.6 million by 2,954, you spend less than $4,000 in Capex in the fourth quarter. If you average out their $55.9 million of Capex for the year, they spent less than $5,000 on average per quarter on each of their 2,954 stores.
So they spent $20,000, less than $20,000 per store for the year on Capex. Well, they're very small retail stores. That's the first thing. Any cosmetic facelift that you might need, and you might not think that's a big number. That's a huge number, $20,000. Additionally, just by thinking about Capex, not every store needs a facelift. Not every GameStop needed something at that amount. Some might have needed 40,000, some might need 5,000. Like just giving you an average doesn't tell you anything. But what it does tell you, one, they shorten the footprint. Two, they actually are spending the money the right way. This is why I tell you stepping over paper clips to get to pennies will equal dollars. This is a penny business. So the less I spend, the better. What did you want? Did you want this drastic number right there on Capex? That's ridiculous. Maybe you don't really know how to pinch a penny, but these are what these guys are doing. They're pinching pennies, Kevin, while you're out there shedding out all yours, running for campaigns and lawyers for getting sued.
Now look, call me crazy. I know they lease a lot of their properties.
Oh, there you go.
But that seems like a very low amount of Capex that they're actually investing into their stores. That makes me a little bit nervous that the company is trying to inflect towards collectibles only because they see the writing on the wall that the pre-owns and the other stuff is going away. And so they're cutting costs, they're cutting employees, they're not actually...
It's going away? Hey, they had $6 billion in sales, 5.92, whatever. And 900 million of that is collectibles. $5 billion in consoles, video games. Oh my goodness gracious. This is just ridiculous.
Actually investing in their stores anymore. And in the meantime, the idea is, let's sell some collectibles, which I'm all for that. I got this Needler, which you can learn more about in the description down below. I got me an affiliate link down there, paid for, of course, along with another affiliate link for life insurance.
How many fucking affiliate links? I'm sorry, I had to cuss, bro. You know what's my affiliate link? Think about this, me, Kevin. My only affiliate is GameStop. I'm actually affiliated with GameStop. And do you know what I don't do? I don't even put their affiliate link on my videos. And do you know why? Because I don't want them to pay me $1. I don't. I'll put GameStop.com before I put GameStop and the little code that they gave me to put on here. You're a joke. You're a complete joke.
Insurance that you can get in as little as 5 minutes, metkevin.com/life, and of course 12 free stocks you can get with Webull. Maybe you can even get yourself a GME stock. All you have to do is go to metkevin.com/free. Now, in fairness, I love the idea that GME is up 48% in after hours.
No, you don't.
Now I have no idea why that turned all weird and pink, but I see 48% in after hours, and that looks awesome. So, what do I think about GameStop? Well, let me give you a reasonable bottom line here. I think it's fantastic that the company is positive on EPS. That's great. And you don't even have to mention the fact that they lost $34 million on digital assets. I was just on the page and then it jumped away. Guess we're having tech difficulties. So there we go. $34 million lost on digital assets. Ouchie wouchie. But anyway, ignoring that, the company is giving us a little bit of...
Don't ignore that. Take that. Relish in it. Just know that they actually announced a profit of $48 million for the quarter, all while taking a loss on digital assets, what they've never taken, of $34 million. Is that the FTX deal? Who knows? I do know this. Marketable securities, you only get the value of what you bought them for, not what they're worth. So until they sell them, you won't know how much money they actually have. That's how you sandbag a number. Additionally, I know that we've paid off numerous top-level executives with severance packages. Those one-time expenses, one-timers, all gone off the books. I know that quarter one of last year, we didn't have great numbers. We didn't have those. We had too many one-timers, as we call it. Don't worry, guys. Inflation was upon you. The whole operating level was upon you. And guess what's going to happen? It's going to be another earnings report in the positive, Meet Kevin. So here's what I want, Meet Kevin. I know you're going to talk because I have no idea. I have not seen this part of the video yet. But I just want you to know that I know, that you know, that I know, that you know. GameStop is going to be positive another quarter, and another quarter, and another one. Then we'll say, hello, S&P 500. Hello. I know you don't know this part yet because you're just sitting there in your chair playing with needlers.
Clickbait. So bottom line, we got some clickbait on cash position. Now, why does clickbait on cash position matter? Well, because in the future, when they increase their inventory, such as for collectibles, what happens? Oops, now EPS goes down, margin goes down, and cash flow goes down. And cash position potentially goes down. Oops, spelled that wrong. Anyway, potentially goes down, maybe goes down, unless, of course, they sell profitable collectibles. So that's an idea. Some
Profitable collectibles would be cost of goods, i.e. the margins would be better. And that's what they're doing even now. But you can't tell me that their cash is in jeopardy in the future. They have enough cash burn to last 14 quarters, according to people's math. But if I do my math, they have enough cash burn to last forever because they don't have a fucking cash burn. Sorry for cussing. Meet Marantz. I cuss.
Some clickbait there on the cash, but I will say around $410 million of cash is actually pretty decent. pretty decent. A lot of stores, I worry that the stores would be getting run down with how little Capex is going into them. I worry about negative.
Hey, beginning rundown. Are these stores like? Is there like massive amounts of shopping carts crashing into counters? I mean, it's all display boxes, right? Display boxes and dust. What do we need to buy for Capex? Guys, get me some more fluorescent light bulbs and a duster. There we go. That's how we improve this store. I can go into a GameStop right now, make it look amazing with some Windex and a rag. And you want me to spend more than $20,000 a year on stuff, on supplies, on Capex? No way. No way. Oh, hey, shout out to all the operators. Shout out to all the managers of GameStop. They're doing amazing. Oh my, and I'm so happy they got shares, and those shares are worth more than what they were. Oh, bring me that Camelot guy too. But meet me, Kevin. Meet me.
Revenues, because you have a company that's not really making money, right? And I will say, even if we annualized this right here, this 16 cents, 16 cents times 4 would put us at about 64 cents. That means in after hours right now at 64 cents, you're paying about 41 times in a price to earnings ratio for this company. So you're paying 41x for a company with negative growth. That also seems to be cannibalizing its inventory below levels that it's ever had before. So I do think there are some red flags.
All right, so when he comes out with 41 times X, that's because it's listed as brick and mortar. This is a technology company for me moving forward. The actual beta that is the NFT marketplace, it's in beta mode right now. It's not even full running. You guys know this part. So that's the whole sector as far as growth goes for me. As in negative growth, well, maybe you don't understand that they've shortened their footprint tenfold. So they're actually disguising the fact that they're falling on top line revenue, and it's really like pushing it through the roof, because less operators, okay, less stores to operate equals more money in your pocket. This is how you become nimble. This is how you actually make a profit. But I love this, Meet Kevin. You'll never talk to me one-on-one, so I got to do the video with you. And I'm looking at these, said negative returns. Huh? You know, when you have a positive EPS, let's go ahead and make a negative video. Let's do that, because maybe that'll explain what's going on. Maybe you don't get it. I mean, I'm sitting here, I'm trying to get what you're saying, but then at the same token, I know that GameStop's going to make, what, $200 million next year? According to your math, $200 million, right? That's a damn good number in the positive. Wonder how much of that comes back to shareholders in due time. I'll be here as a shareholder. Been here a lot longer than you've been making your real estate videos?
I'm very, very happy about the stock going up, because I think that's wonderful for everybody who's exposed to it. From an long-term investor's point of view, for me, this would probably just be something to maybe sort of meme euphoria trade. I do think the numbers are probably better than some other companies that we've seen. In fact, in their earnings call, I thought this was really interesting. In their earnings call, they say, we want stockholders to judge our results instead of our words. I kind of felt like that was a slam on other potential momentum stocks, but who knows? So,
how about it's a slam on you? How about it's a slam on you? Because more than just saying what GameStop's going to do moving forward, like you're doing right now, oh, they're this, they're that, and come to a conclusion. How about you just read the balance sheet and understand that when it says net profit on there, you can't fake that. The whole world's out here trying to gas up companies and trying to hide money everywhere. Oh, they are. You got Balance trying to reorganize their balance sheets. Those banks out there, I apologize. There's no edits, no cuts, like your videos, yeah. You got banks out there disguising their potential losses. GameStop puts it up in front of you and says, go ahead and judge me for my $34 million loss on adjustables, on digital assets. Judge me now. That's a one-time loss. You don't get what they're doing. It's pluses and minuses. And GameStop's phenomenal. And you really don't understand business. Hey, you know what? I actually called out the dollar per share, okay, yesterday. I said what it would reach. I've let people know exactly where the position GameStop's going over the last 2 years and the transition and the route they're going to take to get there. I understand retail, yes. The P&L, I know how to read that part. What exactly do you bring to the table? What do you do for this community that you want to inform other than grift off the community?
Those are my thoughts. Keep in mind, they also had about $21.4 million in stock-based compensation for the last quarter that they added back in. I thought it was less than that. That's under the EBIT. We don't have to talk so much about that. They did say they're creating more of an incentive program for their store owners, so that
store directors, okay, the managers, and yes, if you studied the stock, you would know that they have a share program, RSU program, gave everyone an incentive. People that don't know the company make videos like this. It's embarrassing.
that way, or their store operators, so that way they're incentivized to continue to sell products. So anyway, check out the links down below, and we'll see you in the next one. Thanks, guys. Bye.
Look at the videos down below. All right, me, Kevin. I'm going to give you my conclusion of your nonsense. Well, first off, meet Kevin, meet Marantz. Hi. GameStop. Can't stop, won't stop. GameStop. I've been buying it for 2 years. I love the company, and I love the direction that it's going. Nothing that you can tell me will tell me that it's going in a negative direction. Here's why. Because improvements year over year matter, leadership matters, and cash on hand is king. Maybe you've never met Ryan Cohen. Maybe you've never met Larry Chang or Alan Adel. Those guys took a business with a $10 million loan and sold it for $3.2 billion. We're already at $1 billion. We're already sitting on $5 billion. We're already sitting on enough money to not worry about the things that you're worried about. What you should be worried about, Kevin, is that you push out misinformation like this and people see right through it. Eventually, you'll become irrelevant. Eventually, those links and those click-through ratios that you get are going to fall and drop off like they have. This is why you resorted back to what you're doing now. But all the fluorescent lights in the world can't change the fact that GameStop, net positive position, $1.4 billion, cash on hand that they could write a check right now and do whatever they want with it. And you can't do anything about it but push your FUD. Don't worry. I'll be here tomorrow. Like I said, meet Marantz. Get at me. Peace.